Good afternoon. Time to check in on the markets, and starting off with the picture in Asia, mostly positive with stocks on that front, driven by some of the gains that we saw in the technology stocks. Looking at the Nikkei in Japan, up 0.8%, Hang Seng Index in Hong Kong up 0.1%, and as well as mainland China in positive territory. That inversion that we're seeing between the 2 and 10-year yields does continue to deepening at its worst level since the year 2000. Indicating concern around a possible recession as monetary policy continues to tighten. Looking at the rand, currently stable ahead of the U.S. jobs report, and this is a currency this week that was swinging back and forth based on market and global market sentiment, that is. But to talk to us about the week that was and wrap things up nicely, and perhaps even throw forward to that jobs report figure that we're waiting for, we're joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. So what's driving our markets right now as you take stock of global events?
Look, it's been a very choppy week. I think that we've been finding this week is pretty much a holding action, keeping some ground back after recoveries that we had last week. The commodity cycle once again starting to lean a bit in on the South African markets. So yeah, I mean, when it comes to what's the rand doing or what's our major sectors doing, I think we can look quite closely once again to what the broad commodity outlook is looking like.
As we look back, were there any company news that caught your attention this week?
Yes, certainly. I think it was quite important to note the impending takeout of the Mediclinic Hospital Group by a consortium of Remgro and the MSC Shipping Group. And I think what it highlights is that quite a lot of South African assets are quite cheap, and this is a good example because, of course, it's a very, very large company indeed. So in terms of putting their money where their mouth is, well, they're putting an awful lot of money where their mouths are.
When you look at some of the price action, I mean, whether you're looking at our local indices or you're looking globally, how are you, unpacking that for yourself? How are you understanding what's going on, given some of the stuff that's happening in the background?
I think it's quite a messy environment, and it's looking to find a bit of direction. I think it's the first time I've really seen a drawn-out everything bear market. It's one thing to have a sharp down spike like we saw when COVID suddenly really took hold, and there was a lot of fear and things got sold in order to raise a bit of quick cash. But it's quite another to see assets across the board, whether it's gold, bonds or equities, all going down at the same time. That's relatively unusual, and I think it certainly points towards some confusion as to, well, is the inflationary environment that we're seeing really got traction, or is it truly, as the Fed possibly incorrectly guided, transitory? So I think it's perhaps an indigestion bear market.
On that note then, do SA equities and bonds offer the best value right now? How are you looking at it?
I think they offer excellent value. I mean, building earlier on my Mediclinic comment, I mean, it's not the only company in South Africa that's been taken off the boards, because it really represents excellent value. I mean, sure, a lot of South Africans will be looking at the environment at the moment saying, oh well, it's very tough, there's a lot of unemployment, interest rates are rising, there's load shedding and so on. But I think markets tend to take notice of all that kind of thing, and they tend to understand fully when things are going from bad to less bad, and I think that's possibly where we're looking at. I mean, the background is that I think a lot of issues that weren't taken seriously enough are being taken seriously, will be dealt with, and I think that's going to provide an underpin to our market.
Going into US earnings season, we were all quite anxious because we wanted to see the effects of high inflation on some of the companies that are reporting. What do you make of guidance that we've received from some of the executives when you take stock of the current earnings season on the US?
Okay, so I think generally there's a note of caution, but I think it's also important to remember with things like earnings seasons, there's always a little bit of choreography. With higher rates, companies are expected to find things a bit tougher, reports a little bit of a tougher environment impacting on their earnings, and I think where executives can perhaps pull some reserves forward, they might. If we look at the whole US earnings environment for second quarter, we're looking at it effectively 6.1% gains, which sounds like a lot, but then when you go and strip out energy, it actually is then for the residual minus 3.3. So that's the first time I've seen that for a little bit of a while. Clearly then it's going to be a little bit of a struggle.
Warwick, let's leave it there. Thank you so much for your time. That is Warwick Lucas from Galileo Securities giving us his perspective and wrapping up the week for us. Of course, we are looking forward to that US jobs report figure. Economists expecting the US economy to have added 250,000 jobs for July, leaving the unemployment rate at 3.6%. That is it from me. We're going to take a quick break and then Diabo Seto will be with you until 3 p.m.